Ed Harrison here for Real Vision. I'm talking to Dan Zwirn, who is the CEO of Arena Investors. Dan, great to have you here for Debt Week.
Thanks for having me.
I think before we came on camera, I was telling you off camera that we're having what's called Debt Week. And we're at the beginning of 2020, and the reason that we're talking about debt is just because a lot of people don't understand that debt is actually a bigger market than the equity market. That's right, isn't it?
Yes, the debt markets overall are far larger than the equity markets across loans and mortgages and tradable bonds. And treasuries and all the different obligations are out there. There's an enormous number of things to choose from when you're thinking about playing the markets.
And give me a sense of the size of the comparative size of the market, because when I look on television, I get the sense that it's all about stocks.
Right. Yeah, well, you can imagine there are literally trillions of different opportunities out there. And in fact, we've never had more debt than we do now because of the tremendous amount of issuance that happened over the last 10 years. So a lot of that debt ends up getting bought by the very same people who issue it when you think about the sovereigns globally. But basically, if you're an owner of an asset, there's never been a better time to raise debt against it.
Now, we're going to do sort of a soup to nuts conversation on debt, because my understanding is you look at a full panoply of different markets
Yes.
where, there are potential dislocations. I think of it, there's this term that I came across called fingers of instability that accumulate over time, and then at stressful points, maybe you'll have a trigger and, it will cause a mini a crisis or a larger crisis like we had in 2008. But your thesis is basically that it's not a question of if, it's a question of when we get to the next crisis.
Yeah, I think there's two parts of it. First of all, that there's always some combination of industry, product, and geography where there's kind of a debt crisis ongoing, whether that's due to a particular issuer or a particular country or other geography like a Puerto Rico or a Greece or an Italy, or whether that's related to a particular industry like oil and gas. There's always something going on. And so when we look at all of the things out there, we're always comparing risk reward and thinking, where are people running from, so that we can kind of take a look at where we might want to place ourselves. At the same time, overall, there can be at the end of the day, everything's correlated. And so there are times of extremes like in 08 or 01, 02 or 98 or 94 where a lot of the issues that arise in one or more markets start to kind of bleed into the other ones. In an ideal world, we'd like to avoid kind of macro views generally, because markets can be, if you will, stupid longer than you can be solvent, so to speak. And so we try to focus on where the actual idiosyncratic or alpha-related distortions are the greatest.
One of the things I guess that I'm thinking about is the length of this credit cycle or this business cycle. And you hear the term that we're near the end of the cycle, and as a result, these kinds of issues are things that we want to talk about. Before I go into what those issues are, because I think you have an interesting framework, I mean, what is that term, we're late cycle, what does that mean to you?
Well, I would say it's hard to discern in that we simply, as a statistical matter, don't have that many data points. Depending on who you speak to and the data that you look at, perhaps we have 100 or 300 or 600 years of data, depending on what markets you examine. And so to draw any particular conclusions other than what goes up must come down is difficult.
Right.
Certainly since 08, we have had a series of basically market distortions created by primarily developed market monetary authorities that preclude actual risk from being appropriately priced. So it's been a long, long time since there's been legitimate price discovery in the markets. And at the end of the day, when you look at even equities are ultimately a derivative of the credit markets, right? They're just the thing at the bottom of the capital stack. And so and over time, people compare dividend yields on stocks with yields on debt. And so that entire structure has been distorted by monetary authorities effectively underpricing the front end of the term structure of risk reward. And so what we have is a whole series of distortions that have arisen. When that bubble ultimately pops, unclear, because when you keep rates, flat or negative, and there's very little premium put on top of those rates to price risk, ultimately issuers that are not terribly creditworthy can frequently afford to pay very, very minimal rates to sustain a level of principal.
Yes.
And particularly when structures are really weak, can kind of live to fight another day for years and years and years. And so when we look at the world, we don't want to focus on what the greater fool may do or what might happen. And so we try to focus on places where those distortions have presented themselves, typically in some particular, again, geography or industry, et cetera, that allow us to kind of hopefully take advantage.
And I want to get to that, the specific markets that we're going to be talking about. But first, let's go to your framework in terms of what you're thinking about in terms of where these fingers of instability are. That's because since 2008, there have been some institutional changes within debt markets. And I think you enumerated 5 recently
Yes.
that are critical to thinking about how this could play out. Can you go through, step by step? Maybe we'll go through the 5 one by one after the next.
Sure. Well, so I would first say I enumerated those 5 factors in a kind of an academic paper.
Right.
And there's only a subset of those things that we see that were able to be substantiated kind of at an academic level. It's not to say that there are not other factors that we see in the marketplace every day, but it's hard to get your arms around some of the numbers. With regard to those 5, I would start with collateral.
Right.
So at the end of the day, a number of folks look at default rates as an example. And when they think about the quality or lack of quality of debt obligations. What we have seen is that at the extremes, if I have incredibly weak covenants and I charge a really small coupon, well, then I can have no defaults.
Right.
And so people tend to, at agencies and other evaluators, look at coverage, right? Meaning how much cash there is to cover the obligations that I have from my debt instrument. Well, again, if I don't charge a whole lot, then I can have high coverage and I can be comfortable. Nevertheless, I may have an actual overall obligation that's very large, and in fact, maybe larger than my asset value. And so we tend to look at leverage, not coverage.
Right.
And when you dispassionately look at the amount of leverage in the system across corporate, property, structured finance, consumer, and other personal obligations out there, what you see is an enormous amount of debt relative to the underlying asset value. And actually, you have a tremendous appreciation in asset levels. And what is not necessarily understood is the degree to which people perceive there to be substantial equity value because debt is cheap. And there are situations where lenders tend to price very low because they perceive a lot of equity value. And so those two things are not independently evaluated, right? They're effectively a zero sum.
Basically, you're saying that equity is the residual value with debt at the top of the stack.
Correct. So we're at kind of historical highs in terms of the enterprise value divided by cash flow that people are willing to pay for businesses or assets. And part of that is because we can access very cheap and large amounts of debt that allow us to make equity returns that we otherwise wouldn't have been able to make. At the same time, providers of debt are saying, well, I have real confidence that my loan to value is relatively low because of all the equity that these people with equity are willing to put in underneath me. So effectively, it's like 2 drunken sailors keeping themselves up, right? At some point, one of them might stumble over. And so when you look dispassionately at the credit statistics out there, you're seeing enormous amounts of debt relative to asset values. You're seeing structures that are very, very weak, where people are not getting appropriately protected as creditors at the top of a capital stack. You're seeing terms and duration, right, which effectively we have not seen the intrinsic risk of duration priced as low as it has for decades. Kind of everything is set up such that people are not getting compensated for risks they're taking. And so if you look at the stats across then we go into the second area, the ratings agencies, you're seeing a tremendous amount of BBB relative to the rest of high yield. Why is that? Because there's a very particular subset of investors that will only invest investment grade and above. So there are tremendous incentives to do a whole lot of kind of numerical gymnastics to be able to access an investment grade rating that otherwise perhaps 10 years ago wouldn't have been given, in order to access that group of investors that tends to be comfortable taking a relatively low return for any given risk that they're assuming.
Well, let me back up on two things because and by the way, when you were saying that, I was thinking about David Rosenberg because I spoke to him and he was talking about this too, and I want to get a point in about the credit quality of triple Bs relative to what they were before.
Sure.
But the interesting thing, and I think maybe this is a rhetorical question on some level because you mentioned the Fed and other central banks in the developed economies, but why is it that these investors are not being compensated for extending out for duration or for taking on the risk that they're taking on?
I think it comes down to the sheer supply and demand. There's only so many issuers, and there's such a tremendous volume of capital that needs to be deployed and needs to attempt to get some level of return that people are willing to accept historically low levels of return when they think about the return they're getting relative to the other alternatives they have. And so when you see, unfortunately, a kind of a vicious cycle where if you lower rates, right, you make that hunger for yield all that greater, right? And you have people who are willing to buy more of it and take less return over time until the market tells them no.
So, one of the things that hits me when you talk about this is this whole concept of servicing debt. Debt service cost being the marker versus leverage.
Yes.
To me, that smacks of hubris in the sense that as soon as rates go up, those debt service costs go up, and suddenly you have what seem like low default rates not become low.
Sure. Well, certainly that's certainly the case with regard to floating rate obligations. But ultimately, even fixed rate obligations, as they reprice, will be priced against the available floating rate and move up themselves. What I think is not taken into account by investors frequently is the fact that there's a level of correlation between risk-free rates and premium to risk-free. And so if you see a real move up in risk-free rates, ultimately you frequently see big moves up in spreads. And at the same time, if both happen, you have potentially a reevaluation of the underlying asset yields necessary to appropriately compensate investors for owning assets or enterprises, and therefore a material decline in not only asset values as they're perceived, but also, more importantly, equity values that are subordinate, effectively leveraged by that debt. And so these things can spiral out of control as they have in prior crises. That said, again, there's tremendous incentives on the part of monetary authorities to kind of keep rates low, and as well as support the term structure of risk through other means, including kind of buying obligations directly in the marketplace. So I think while a crisis is not inevitable, it may be highly likely, and in fact, it may ultimately be preferred, because I would argue that what is inevitable is either a crisis or a long-term malaise. Where, as an example, where you have Japan already at, and potentially Europe going. And so that's not such a great thing either. And so we have this tremendous number of distortions happening because risk isn't appropriately priced and because price discovery is not out there. And in fact, that leads to the third issue, which is that in addition to the fact that collateral is relatively misjudged in terms of its underlying risk, and in addition to the fact that it's not necessarily evaluated appropriately by available agencies, you have the fact that in the wake of the crisis, the number of people who are willing to make markets in fixed income across the world is very low. And to the extent that they're willing, their ability is in turn very low.
And why is that?
Well, I think part of it is that there's been a tremendous level of pressure, perhaps rightly applied, post-crisis on banks that participate in market making. One, to effectively put capital up against certain obligations in their balance sheet at levels that really preclude them from owning that risk in the first place. And second, through the Volcker rule and other rules that they have to follow, there is a tremendous level of pressure for them not to effectively take a proprietary position.
Right.
And so, unfortunately, in over-the-counter markets, the difference between making an OTC market and taking a proprietary view is very hazy. And so, why take that risk when the downside of doing so is so great?
And so that means basically liquidity has been shrunken over time.
Tremendously so. And so, as an example, we in our business, we owned a few million bonds of a $400 million issue, and decided after doing additional work that we didn't want to be involved. And it took us almost 2 weeks to get out of, just a couple of million bonds. And so the reality is, and that turns to another factor we see out there, not one of the five, but as a general whole, there's have and have not mentality.
Right.
Which is that if you are a have, whether it's corporate, again, property, consumer, et cetera, there's really no lower bound on the level at which you can borrow. But if you are have not, there's really no price you can pay to get access. And so what happens is if you have an obligation of one of those have-nots, it's effectively a permanent holding,
right?
Until and if you effectively get your hands on the assets, either through a maturity or a covenant violation, et cetera, and effectively force the monetization. And so that then leads to yet another factor, which is the mismatch in assets and liabilities across many of the entities that have been raised in order to house a lot of this fixed income. And so you'll see in mutual funds, shorter duration hedge funds, ETFs, and others, situations where there's a presumption that you'll be able to kind of sell the obligations in order to deal with redemptions that's not really there. In fact, even in the last couple of years, you've had situations in Europe where there are property trusts effectively that own giant real assets that are levered, that are daily liquidity open-ended. And people somehow still are surprised when, in fact, the redemptions come that they can't effectively sell those buildings on demand.
And so I call this fake liquidity basically in a sense that the underlying asset is illiquid, and then you have a liquid trading ETF
Yes.
or other sort of asset on top of that, and people get the sense that I can get in and out of this when actually the underlying asset, there's a mismatch there.
Right. So either you, in fact, won't be able to get out and redemptions will be suspended.
Right.
Or there'll be very relatively low correlation between the price of the ETF in which you're invested and the actual price action in the underlying assets. Either way, you're kind of not getting what you thought you'd get at.
I mean, you could see net asset values of these ETFs, they could trade well below the stated value. Because I'm thinking about it.
Not in open-ended, right?
Yeah.
In open-ended structures, the NAV is the NAV. In closed-ended, you can have a discount to NAV, right? And that's fine because there's a fixed number of shares effectively, and those trade where they trade independent of the NAV. But when you have open-ended and you have redemptions, people actually need to get their money. And so you have things like the breaking of the buck that happened in the kind of
the money markets funds.
In the money markets, right? And so I think there has been relatively little focus by regulators on this asset liability mismatch out there because it presumes a backward-looking view at what obligations had liquidity at one time. So they'll be surprised. And if you go back to, for instance, 1998, between August and December, there was basically just no trading in anything OTC.
Oh, yeah, I remember that. I was rotating through at Deutsche Bank on a synthetic product market for Russian currency obligations, or actually Russian, I forgot what they call them now, but basically that whole market blew up and there was no trading.
Yeah.
People were panicked as a result of that, and that's when the Fed had to step in, or those companies stepped in.
Well, and by the way, that leads to the fifth of the five factors that I wrote about, and that is that the regulatory control has been far greater now. Mm-hmm. And so, many years ago, people who had hedge funds didn't necessarily have chief compliance officers or general counsel or third-party marketing. There's a lot of things that have been instituted since those earlier times that may point to situations where effectively people are going to shut down or suspend redemptions because they can't strike a NAV. Right. And so, as an example, in 2007, when you saw BNP Paribas mortgage fund had issues, part of the problem was they couldn't actually strike a NAV because they couldn't get prices. And so they said, okay, well, no investors can move in or out.
Right.
And that in turn kind of creates panic.
And to me, this liquidity issue, there are tons of other things I want to go back to on those five because it's great, and especially with regard to the ratings agencies. But this liquidity issue, I find it very pernicious. When you think of potential triggers for what I would call contagion, to me, that's a primary vehicle.
Sure. Well, I think you never know where it's going to start, right? And when you saw what happened in Asia, those were issues that had arisen in the early mid-'90s that didn't kind of really catch fire until '98 with the Thai baht issue. I think at the same time in '07, you could have pointed to many different subsets of fixed income where pricing was really, really off, but it happened to be that the fire started in residential mortgages. What we all know today is that whatever it is that will cause it will be something unexpected.
Right.
Whether it's something like those two situations, or there's a enormous fraud like what happened in WorldCom, where the market suddenly repriced in the wake of the revelations that occurred in that company. You just don't know where it's going to come from.
Just to back up a second, your second thing when you were talking about the ratings agencies, I thought that was interesting because basically you were saying that 10 years ago we could have had EBITDA, debt to EBITDA ratio or leverage ratio of X. Now we can have 1.3X, and the ratings agencies will give us the exact same rating that we had before. Why is that happening, and how is it that the ratings agencies are not cracking down on that? Why are they letting this sort of slow bleed into basically double B statistics for all these triple Bs?
Well, today's triple B was yesterday's double B, and I think I was actually invited by one of the large agencies to come in and discuss this, and I don't think they'd agree with me, but nevertheless, I think the statistics do point to it. And furthermore, I think that even if you assume a static level of, as an example, debt to EBITDA, what counts as EBITDA these days is much different than before.
Right.
And so there are these tremendous numbers of different adjustments that are taken into account, even all things being equal with regard to the credit stats that exacerbate that issue. And so ultimately what you've seen is that when individual names, even in the last kind of quarter or 2 quarters, they crack big. Because there's a total reevaluation, effectively moving a credit from a have to a have not very suddenly. And there are these step functions downward in the pricing.
One other issue before we go to individual asset markets that I thought, just jumping back to this leverage, or rather to the liquidity issue that I found very interesting. I read the paper that you had co-written about these about the illiquidity. And one of the things that you mentioned that caught my eye was the fact that if you have a stock, let's say the stock of GE as an example, there's one stock, common equity, it's liquid traded over a market. But if you have a bond, first of all, as you had mentioned, it's OTC where the markets happen. There's no New York Stock Exchange. But also you have discrete issues that are much smaller,
yes.
and so the liquidity is almost automatically constrained in those markets.
Yes. Well, I think part of where we've seen opportunity in the tradable markets is that these days there are relatively few folks who are simultaneously looking at, as an example, bank debt, all the bond issues, CDS, stock, and options. Right, so there are situations where there are distortions even within capital structures, and so we see situations where effectively we can create cheap options, cheap put options, cheap call options through different combinations of those securities that will never require us to seek a bid from someone else. Right, and so a key thing that certainly I learned pre-crisis even was that in some of these OTC markets, there are a subset of opportunities available that are effectively self-liquidating. So you can be effectively someone who benefits from the lack of liquidity, right, by having a bid when people don't want it, in that subset of situations that are self-liquidating, so you yourself don't need that bid, right? So you're never relying on the greater fool.
Well, let's go through some of these markets one by one. One that doesn't get a whole lot of mention that I find interesting because it goes to the reach for yield is private credit.
Yeah.
Private credit, my understanding of it is that people said, look, we're long-term investors, so we don't really need to have liquidity. So we can invest in these private credit actions and wait it out for the long term.
Right.
What's going on in that market? Why is that not and as a result, we can get a higher yield, obviously.
Right.
Why is that not a story that makes sense?
Well, I think the original thesis was that there was a difference between obligations that were traded and or had CUSIPs, right, and private obligations. The underlying presumption is there's a different level of liquidity. And by not having a CUSIP or not being traded on a desk, I should get paid more.
Right.
The reality is that difference is not really there. And the reality is that the leveraged loan markets and the middle market lending markets effectively price against each other. And so there's been a real harmonization between those two markets. So that's point one. Point two is the notion that I'm somehow intrinsically more patient, so I don't need market making to be there.
Right.
May or may not be the case. However, what it doesn't take into account is effectively the fact that the longer I have a debt obligation, because I'm never going to get paid more than par, right? So the longer a debt obligation I issue to a borrower, the more put optionality I'm short, right? And so effectively, I throughout the life of that loan, I can only make my coupon, but I can lose it all at any given time.
Right.
Right. So if I can only lose it all for 2 years versus only losing it all for 10 years, all things being equal, independent of market making capability, I'd rather have the 2 years than the 10 years. And when you look at the differentiation between pricing on things that are short versus long, it doesn't reflect that. And so people have been willing to effectively be super borrower friendly in that regard.
Right.
And that will ultimately cause problems. Third is the aforementioned drunken sailor issue, which is that in the middle market, lenders are taking comfort from the fact that, well, geez, if I'm lending it 7 times and an equity sponsor is putting up 4 times, I must have an LTV of 7 divided by 11. But ultimately, the equity provider is paying that equity out to the seller. It's not somehow staying in the enterprise. And so independent of what the equity sponsor viewed to be the enterprise value of the enterprise, I'm still out 7 times, right? And so in fact, it may very well be the case that instead of 7 divided by 11, my LTV is 7 divided by 8. And then the question is, am I getting intrinsically and appropriately paid? The equity provider might be willing to provide that 4 turns of equity because the pricing of my debt is so cheap that he can still make an equity return. Whereas at the same time, I take comfort somehow as a lender in lending 7 times, and I'm somehow then willing to charge really low because of the presence of that 4 times. And so the two work together to effectively overprice an asset and put the asset in a position where the equity is disproportionately paying up, but also getting taking advantage of the amount of debt, the pricing of debt, and the duration of debt, as well as the structure of it.
Related to that, I guess, is leveraged loans. When we're talking about this market for bank loans, there's a tradable market for bank loans, leveraged loans, and a lot of people talk about high yield and leveraged loans as a collective market, which is of the size of the mortgage market.
Right.
So dislocations there could be a trigger point in a crisis situation. What's going on in those markets, and do you think there are opportunities there?
Well, I think there are clearly ultimately going to be opportunities because the credit statistics don't make a lot of sense. Mm-hmm. If there is a reason that those opportunities may present themselves, it's because a number of middle market lenders themselves are levered, right? Typically 2 to 3 debt to equity in their own capital structures, which they're then using to make loans to issuers. And in fact, even more CLOs are 10 or more times levered and owning these obligations. Now, those who are sanguine about those markets say, well, versus previous times, there's a level of asset liability matching between the owners of CLOs and the capital structures of the CLOs and the underlying obligations. True. However, that doesn't take into account the fact that there are effectively triggers in the capital stacks of CLOs that may shut off distributions to certain pieces of those. And furthermore, that in fact, while it was the case that a lot of that really bad CLO equity did come all the way back post-crisis. That doesn't take into account the diminution in the quality of the collateral, as well as the intrinsic notion of, if I am a semi-institutional owner of CLO equity and I get a statement saying my equity is down 90 cents, am I going to just calmly be able to tell my stakeholders that somehow it's going to be okay if we all just wait a decade, right? The answer is probably not. And so there's a lot of reasons why there can be issues. And again, in the last couple of quarters, we've seen that arise where a given leverage loan that is relatively low quality has turned out to be owned almost exclusively by CLOs. And when you take that issue and the fact that they don't want to own collateral that could cause triggers in their own CLO structures, and you combine that with the fact that there's relatively little market making, and in fact relatively little ability to even get information on the credit, what you have is that when there are issues in those underlying credits, all of the owners of it want to sell all at the same time and have a bunch of buyers who are not located, a bunch of intermediaries who are not transacting, and information that's not well distributed in order to make a market happen. And so what you've seen then is step function down pricing, right, until it finally clears at some really tough level.
And doesn't that have a knock-on effect to the other issuers that are within that same collateralized loan obligation?
Yes. Well, this is a great example of one of the factors that I considered putting in the paper, but it was hard to get numbers around in order to substantiate at an academic level. What we've seen anecdotally is you suddenly start to have credits that are owned by different structures, different organizations, different funds, different CLOs, each of whom have their own particular interests in situations.
Right.
And we've seen firsthand situations where, as an example, a creditor is willing to do things that are really unnaturally generous to the equity owner in order to not acknowledge the credit problem that's there because they don't want to trigger something in their own structures that may hurt their own credit. And so if that happens and you happen to be a creditor that just wants its money back, you're going to have conflict not only with your borrower, but with your fellow lenders.
At a sort of macro level, when we talk about CLOs, collateralized loan obligations, to me it strikes of mortgage-backed securities in the sense that you're taking credit and you're putting it into a structure, slicing and dicing and so forth. Can you give viewers a sense of what's going on in that market, what's going on in the whole collateralized debt obligation market, and how CLOs, collateralized loan obligations, are coming to be an outsized portion of that market?
Well, I think what you fundamentally, if you kind of boil it down, what you have going on in that market is very similar to what you had in the mortgage market, which is that ultimately it's very unclear who bears the risk. And so there's a tremendous amount of incentive throughout the chain of value for more and more paper to be issued, and very few people thinking about what the outcome is going to be, right? Why is that? Well, because if you look at these very leveraged structures, in many instances, the manager of that leverage structure is not the owner of the residual risk in that structure. There, for a time, were rules around creating what they call skin in the game, where the manager needed to have exposure to the obligations. Those were effectively taken away again. And so what happens is there's a whole lot of people who own that risk without managing at the same time. And so therefore, if I'm a manager who's taking no risk, my incentive is just to manage more under any circumstance, because I'm not going to be suffering the consequences. Similarly, in the residential mortgage markets, you had that times two, which was that not only do you have that same dynamic, but you had originators who weren't going to wear the risk, right? Who just needed to originate it. Owners, managers of the risk, who just needed to own collateral of some sort and weren't taking the risk. Right? And on top of that, you had effectively managers who were able to get short certain of the obligations. So not only were they not interested in the positive outcome of the deal, they were interested in the negative outcome of the deal.
It sounds just like the mortgage market in that way.
Yeah. And so we haven't seen people materially, I have yet to hear of CLO managers effectively getting long protection in components of their deals, but every other piece of that incentive cycle or structure is there.
Right. Interesting. One market that I think that you expressed some interest in before we got on camera was about the commercial property market. When you talk about commercial property, I mean, it goes back to the story I was telling you about with the High Line and how I used to live there 20 years ago, and how it's just unbelievable how much building's going on there. That at some point, it seems to me that that's not going to come to good.
Yes.
What's going on in that market, and what are the pitfalls there?
Well, I think throughout urban markets in the U.S., you're seeing very, very high prices, driven again by access to capital and the cheap pricing of capital. Mm-hmm. And that's not only with regard to existing assets, but also it's very much encouraged the building of new assets. And so I think if you surveyed people in a number of the largest city markets in the U.S., what you'd see is occupancies are starting to get shaky, rental levels are starting to get shaky, the ability to sell out condos is starting to get choppy, and there are a number of people with construction loans that are very nervous. And so we like those situations. In fact, in Manhattan, we purchased a mortgage loan of a situation where there was, you would have thought it would have been a relatively easy sellout, whereas unfortunately we're going to have to go to effectively a multifamily rental business plan in order to make it work, because the bid's not there on the condo side. And that's already happening and showing itself.
And when you look at this, are you looking at it from the long side or the short side in terms of here's a distressed market, and I could get in long, or this is a distressed market and I think that actually bad things are going to happen?
Both, right? Mm-hmm. So in direct obligations, we are looking to buy existing obligations at discounts, either to reprice or restructure commercial real estate assets, but also looking to make new loans in situations where people are stuck in some way. Mm-hmm. And at the same time, within the tradable markets, there are certain situations where you can create either short situations or cheap put options. For instance, in situations where, as an example, a lender might have that's publicly traded might have overlent to some of these urban markets, mm-hmm. and you can create a structure using different capital structure components that leaves you effectively net short the outcome there in a very, very leveraged commercial real estate lender that is exposed to these markets. So that actually allows us to create a very interesting, compelling, cheap put option, but also one that's inversely correlated to a lot of the other bets we have.
Right. And which markets in particular do you find interesting? You mentioned New York. Any other markets that you're interested in?
We've been involved recently in Miami, mm-hmm. San Francisco, LA. I think Chicago. We're involved in all of them, and I think you're seeing the very beginnings of real issues there. And again, those have been fueled by cheap access to debt financing, cheap access to securitization markets, and this kind of hunger for yield. And so I think we'll see that moving along.
One other question I had on that is that when you talk about commercial real estate, there is the business side that is, where I'm renting out to businesses, but there's also I'm renting out to families, multifamilies, et cetera.
Sure.
And then there are within the family sector, there are levels. There's the entry, mid-level,
sure.
luxury, super luxury.
Yes.
Now, anecdotally, I understand that at the very high end, there's a tremendous amount of overbuilding
yes.
in Miami in particular.
Yep.
Any thoughts on that?
Well, there has been. We actually are a very significant residential mortgage lender in Miami, mm-hmm. and related markets. We do it in a way where we're focusing on non-U.S. citizens. Mm-hmm. And so instead of lending 80% for 10 to 30 years at 4%, we're lending 55% for 2 years at 12%. And so we are creating those positions at the level that we're lending at levels equivalent to where they would have traded in 2008. And so we feel relatively protected from what may come, and in fact, may be a beneficiary of what may come. But yes, we've definitely seen prices move down at least 10 to 20% across the board there. We've seen the ability to sell condos go down significantly. We've seen people get stuck in construction loans. And so it's, again, I would call it a first or second inning opportunity, but we're going to see a bunch of it.
And when you think opportunity, again, short, long, that was an opportunity on the long side that you were talking about,
yeah.
But what about on the other side of that?
Well, actually, the commercial lender that's publicly traded that we're net short has a big exposure that itself is 10 times levered in that market.
Right. Interesting.
Yeah. In that situation, we're effectively we've set up a trade where we are long a put and short a call spread. Where that package effectively doesn't expire until after the election.
Right. And the election, what's the significance of that date?
Well, the thought was perhaps on one side you'd have a guy who's no longer interested in jawboning rates down, or someone who is far less interested in kind of the positive benefits for commercial actors.
Right.
Either way, that may not be good for yields.
And the interesting bit about that is because we haven't talked about politics at all during this whole thing. I mean, 2020 is an election year, pivotal in some ways. Do you think that what sort of impact do you think that's going to have on debt markets in general, or could have on debt markets? Because that's one.
I do. It could be. I think that on the Republican side, if there's a Republican win, I think you're going to see relative stability relative to where we are today. Although, as I said, you may either have less incentive, unless he decides to have a third term.
Right. Yes.
There's less incentive to effectively jawbone rates down, and there's certainly a greater chance, all things being equal, of creating a geopolitical issue. On the other side, depending on who you have, I think if you have a Biden presidency, everything is just going to be fine. But if you have a far left presidency, if you looked at the UK election and you saw some of the policies that the Corbyn folks were proposing, those could cause some things like that could cause real havoc.
The interesting bit is that this dichotomy that you're presenting does leave the potential for a uptick, not only in rates when you look at the term structure, but also in terms of spreads.
Yes.
So that could trigger some of the things that we're talking about in terms of a phase shift, in terms of those on the weaker end starting to default.
Yeah. Well, I think there are a lot of places where that could happen. Again, geopolitical is a big one, but I think you could see a large scale fraud. I think we've seen things like Steinhoff and others where they're not quite the kind of global issues of an Enron or a WorldCom, but there have been these very generous credit markets have allowed people to manipulate numbers.
It's the bezel, if you will.
Yeah.
Like John Kenneth Galbraith said,
Yeah.
that we don't see the bezel now.
Yes. And so, as Buffett said, when the tide goes out, you see who has a bathing suit on or not. And so there's, I think, a lot of things that have been covered up. If we didn't have the crisis, we would have never seen Madoff, right? It was only because of the crisis and the fact that a number of his investors needed to redeem in order to cover other obligations that the fact of the matter of his operation came to light. And so who knows what such things can bring.
Now, one last thing in terms of markets, it's less sexy. The investment grade market, opportunities there that you might see, either long or short.
I think when it comes to that world, all things being equal, we're probably most interested in municipals. Many years ago, I created one of the earlier businesses focused on distressed municipal finance. And because of the fact that you have a relatively slow world with a lot of investment grade holdings, a lot of which are not general obligations and are property or project specific, there's a lot of small issues out there that are going to have problems. And so that's an area we've begun to look at again. All of these things cycle back, good and bad over time.
Right. And then the GOs in terms of versus the specific obligations, which ones present the most problems in a downturn scenario?
Well, there's clearly already basket cases brewing, right?
Right.
Things like Illinois and Connecticut, et cetera. The issue there is what price is the right price? There's no limit to the lack of responsibility of those governments. And so, handicapping how that's going to go is very difficult. I would argue that when you see situations like that, it creates situation-specific opportunities because, again, the baby's getting thrown out with the bathwater.
Right.
So as an example, in Puerto Rico, we're very active across a number of different underlying collateral types, but have never been involved in the GOs because
Right.
there's so many things that are hard to hard to kind of handicap, hard to guess how they'll go. It's for us, it's very hard to take a view.
So, I mean, on the long side, basically, if you do your homework and you say this particular asset or this income stream is what's behind this particular asset, you can actually do well when they throw the baby out with the bathwater.
When that's the case, and as well, there's a trigger that will allow you to actually realize the pricing distortion, right? Is there a maturity or a covenant violation or some other thing that will allow me to actually get at the asset, sell it off, and effectively monetize the difference between the price at which I'm paying and the level at which I'll realize. People get hurt in situations like, for instance, when the convertible bond market exploded in '05. Generally, convertible bonds are very long dated with very few covenants. And so you're just kind of sitting there waiting for a greater fool to take you out. And furthermore, in that case, a lot of those players were leveraged. And so they needed to seek a bid however they could get it. And so at that point, we went from zero to $500 million worth of that. And then people started to come back in the market and we got back out again. And so we always want to be on the right side of that equation where we are effectively a global chaser of illiquidity and are providing a market, effectively a market-making function to people who have no other option.
Right. Let's dive in a little deeper into this the CLO thing because a lot of people are very interested in this.
Yeah.
I think that the question is in terms of the specific structures that you're looking at to take positions there, how do you take advantage of what's happening in that space?
Well, part of the reason why what's happening is because there are very few ways by which you can effectively get short that scenario,
Right.
those situations. In contrast, in the mortgage business, pre-crisis, when people created mortgage securities or even mortgage securities made up of mortgage securities, there was a pretty ready market by which you could effectively create credit default swaps
Right.
to take a view against those. As a result of what happened in the crisis and the lack of market making that's out there, the degree to which you can kind of be very nimble about using CDS in order to get short components of structured finance structures is very much reduced.
And why is that?
Because a lot of people got murdered doing it or trying to do it. And,
Right.
and ultimately, a lot of that was predicated on situations where perhaps everyone had the same amount of data, but there were different levels of ability to understand and interpret the data. And so people didn't feel good about it. When the...
Because this is like a bespoke market, basically.
Yes.
Right.
Yes. And so we have yet to see opportunities to effectively get short structured obligations within stacked securitized
Right.
capital structures using CDS.
Right.
What you can do is use CDS in corporate credit specific ways, and you can do that against different parts of a given company's capital structure. We'd love to do things like that within CLOs. It's just no one will take the other side of it.
Right.
And so that will potentially allow it to persist, but on the downside, it may allow it to persist such that the distortions are so great that when it explodes, it really explodes big, right? Within corporate-specific situations, as an example, there are situations where we can be long a bank loan, long credit protection to create a basis differential that'll effectively collapse because they're two of the very same things. Or we can effectively use puts or other long-dated options in order to create situations where, as an example, we are long a mid-tier part of a very large energy company's capital structure, but we're also long a very long-dated out-of-the-money put. And so having set that up, we know that there's a very small bound of points we can lose, and anything better than that is kind of ups, right? And so you may not actually create a cheap put option. In that case, you would create a cheap call option. But the reality is that these pricing distortions within capital structures provide opportunities to create cheap optionality off the back of the market.
And these are, what sort of duration are you talking about in terms of how this
Within 3 years, typically.
One other market that I think is interesting, and I think in particular because a big debt manager said that he expects defaults in emerging markets in 2020. Emerging markets are generally considered, moving out the risk spectrum in the same way that, high yield would be.
Yeah.
What's going on in that market in terms of this reach for yield?
Yes. Well, over time, all things being equal in a given kind of industry or business, you'll see people demand a premium if they're going into an emerging market, and so ultimately they're taking a view on a sovereign and its effective fiscal sanity, as well as its adherence to the rule of law. And so I think what we've seen is that the degree to which sovereign finances are managed appropriately is very different among different emerging markets. Similarly, even within a given emerging market, as regimes change, as governments change, the degree to which those governments act responsibly can vary quite a bit. And so what it creates is real volatility. And so when everything is comfortable, well, then you get your little extra 100 bips on this oil company versus that developed market oil company, and you're happy. But again, when you see what reality is there's a correlation, right? So when risk-free moves up, spread moves up, perceived issues within a given series of markets move out, you have real problems, and those are then further exacerbated by the fact that a lot of this is intermediated, right, by people who aren't making markets, and a lot of it's held in structures that are relatively short duration and don't take into account the lack of intermediation that's there. So when we think about emerging markets, like in many situations, we want to own the volatility for free, right? And so when you see those explosions, at times that creates babies that are thrown out with the bathwater that you can take advantage of. And so, as an example, we find ourselves at times looking at busted assets in Greece, or we're looking at private transactions now in Brazil, or we've done things in Argentina at precisely the time when people are really kind of freaking out, right?
And are these more on the public or the private side in terms of the issuers?
Typically, they are private side transactions that are able to get priced because of what's happening in the kind of broader universe.
Okay. So now, I think that's a perfect example, a good lead-in into what we're talking about in terms of opportunities, and you've already talked about that, owning the volatility. You talked a little bit about some of the things that you could do in CLOs. Where are, from your perspective, given the outlook that you're seeing on a sort of a macro level, where do you see opportunities in debt markets going forward?
Well, it really depends on the geography. Today in North America, I think we're very interested in non-sponsored private corporate debt transactions. We're very interested in the whole universe of funds, meaning buying and selling interest in funds, lending to funds, because the wrapping in the funds in a fund structure precludes normal kind of corporate-oriented lenders from being involved. There are frequently opportunities, and there's been such an explosion of issuance of those funds, and there are so many misalignments of interest among LPs and between GPs and LPs. I think that will be an opportunity for years and years to come. We're also very interested in North America in oil and gas, which has basically been completely redlined by the banks, who periodically effectively take price bets. We like oil and gas where we don't have to take bets on oil and gas prices. And so there are times when everyone wants to do oil and gas, and the Enrons are there and the Mirants are there, and no price is too low. And then there are times when it all explodes and no one wants to touch it. And in the latter instance, we're involved. And actually, now over the last 20 plus years, this is the third time we've been heavily involved in that area.
Now, so you don't think that the oil and gas is due, especially because of maturities coming forward, for a difficult period where rollover of debt causes sort of a problem in that space?
Oh, I think it very well could be. I think there's a lot of in the tradable markets within energy. There's a lot of misinformation or bad information about underlying asset values that has yet to kind of make itself known. Without getting too specific, basically within oil and gas tradable markets, there are ways to look at the quality of different types of assets. So as an example, there's a notion of proved developed producing, which is basically I stick a straw in the ground and it comes right up, and all the metal's there in order to make that happen. And then there's proved developed non-producing, and then there's proved undeveloped, and then there's probables, and then there's kind of lower levels of probables. And so in the private markets, when we get involved, we only care about the stuff that it doesn't take a geology degree to understand.
Right.
When you look at the way credit has been provided to those markets, there's a lot of assumptions about exploration risk that are embedded that will leave people incredibly disappointed. And so I think there's a real opportunity for that to happen, but it might not, because of the same factors we've talked about with regard to monetary authorities and the overall over-provision of credit. What I am certain of is that in the private markets, where you're not getting agency ratings, where you're not getting large leveraged loans, there are very few options available. And so I'm quite certain that there are opportunities where, again, the non-geologists out there can make very limited, low LTV, high rate bets that where we are able to effectively force our borrowers to sell forward the commodity, so we're not taking commodity risk, and we can charge 15 or 20+%.
It sounds like you're talking about both the short as well as the long side.
Yeah.
So rather than finish off talking about the short side, I want to talk about the one last point that you made about the monetary authorities.
Yeah.
Because a lot of this, earlier in the conversation, we were talking about Europe, Japan, and the United States, and there are two potential ways that we could go. And it sounds to me like there is the potential for, given the fact that debt servicing costs are low and increasing rates creates the potential for exactly the kinds of crisis situations that we're talking about, that we just keep going at this very low,
Sure.
Stasis level, turn into the next Japan.
Yeah.
Do you really think that monetary authorities won't be there as the buyer of last resort, essentially to bail out the system if the situation starts to unravel?
Well, it depends on how much freedom of movement they have at a given time, right? So if you haven't been raising rates and if you haven't been curtailing your buying, and it's time to start, lowering rates and buying, you don't have many more bullets in the gun, right? And so I think they're trying to gently, reload so that they can be there. But ultimately, when you're not, what ultimately is going to happen is you're going to damage those who are the savers, those who are responsible, by debasing your currency, because that's the only way it ultimately works, right? Which is you service the debt with devalued currency, and you become basically a giant emerging market.
And you think basically that that's one way that we could go in the United States, or we can deal with the problem head on?
Yeah, I think there's very little incentive for it to be dealt with head on. And so ultimately, if a crisis arises, I don't think it's going to come in the way that it did, as an example, in the 80s, where Paul Volcker, Volcker 1.0,
Right.
took a stand, made rates appropriately price risk, and effectively caused some short-term pain for long-term gain. The will of central government monetary authorities to do that kind of thing, I think, is very low, and so I wouldn't hold my breath for that. And so, therefore, if we see something precipitate a crisis, it'll be one of these things that none of us counted on, whether it's geopolitical or fraud related or whatever it is, that'll kind of cause an issue. Where that comes from, who knows?
It's been a pleasure talking to you. I mean, this has been a great soup to nuts conversation on debt. I really appreciate it, Dan. Thanks for coming on.
Thanks for having me.